Hello, everybody, and welcome to Derek Miller Invests. I'm your host, Derek Miller. We're going to do something different today. I rarely actually do this live. I tend to record it, about 4 seconds before I go live so that I can cover everything I want to get covered. But today I thought it might be a good opportunity to be actually live and see if there were comments and questions that I could answer live. I mean, what I'm going to talk about is going to be the market, right? The stock market in general, talk about crypto, any financial type stuff. So if you have any questions, make sure to comment and ask. That is why I am actually live right now, so that people can actually ask me some questions. I had someone say to me before hey, you're not actually live. Like, when are you doing this? And I mean, as you can see in my live videos every single day, they are covering the current market action, right? Like, it is that day, is the price movements and the volume movement. So it's as close to live as possible while I still get to cover everything. But I thought it might be fun to jump on and actually do a little bit of live. So that's what I'm gonna do. Let me see something here. I'm gonna get rid of that. Yeah, there we go. Let's get rid of that. Perfect. All right. Wait. Up. I want to go back to the chats. Sorry. Just getting used to this thing. I want to overlay it. Show. Make sure to comment and ask. Let's. No. Let's leave it. Nah, let's hide it. We're okay. So yeah, no. Make sure to let me clarify that statement. Make sure to comment and ask any questions that you have. There we go. Let's go ahead and throw that up. Oh, look, I misspelled questions. I mistyped questions. That's okay. We'll leave it up anyway. It'll show that we're actually live. So what should we take a look at? Well, I know I think this only actually shows the comments on Facebook and YouTube. I don't think it shows them anywhere else. I don't think it shows them on Twitter. So what I'm going to do is I'm just going to jump in and start looking at some things. And I think one of the first things I'm going to look at, and I'll put this up here. Let's add. We're going to look at TLT. We are going to look at QQQ. We are going to look at SPY, and then I'm going to run through some stocks. So for now, let me throw that up so that you can see it. We're going to take a look at this stuff right now. Okay, let's get rid of these captions. Perfect. Back to the chat, which I don't think I'm going to get much chat here, so I'm going to remove this overlay. Just because I don't think I'm going to get much chat. So let's jump over here. I mean, there's only one person even viewing right now, and it's probably from Twitter because I don't see any viewers elsewhere, which is fine. Whatever. Let's take a look. So I'm going to share my screen with you. Let's jump over to... All right, we're going to go on to a monthly chart. I want to show you something on the this is the 20-year treasury, everybody. This is the 20-year treasury, and where our interest lies in everything that we do is identifying large institutional footprints. That's what we're concerned with. Why are we concerned with large institutional footprints? Well, they tell us a couple of things. One, the people that are in control of markets, the people that do most of the market making and most of the, cause most of the price fluctuations, are also the same people that have most of the money. Therefore, they create most of the trading activity. That's institutional footprints. So when I say institutional footprints, that is what I'm talking about. I'm talking about a lot of trading activity in a very small time period, usually a small time period. But the reason we're looking at the 20-year treasury via TLT right now is This isn't exactly a short time period, folks. This is all of 2024, and it is after treasuries have fallen from one. They've fallen 50%. The 20-year treasury ETF has fallen 50%, and now all of a sudden you have volume at what would you call it? So let's take a look. So this was average volume before 2024. This is average volume in 2024. Okay. You tell me what the difference is. I would say this is 300%, 350% higher than average. Notional, everybody. You don't have to, I don't need the numbers. You don't have to have an eagle eye and go, oh, well, the top's actually here if you really zoom in. Who cares? That's 350% of the average volume taking place for the last 8 to almost 9 months on something that fell in price by 50%. Now, institutional investors, the stronger hands, the hands with all of the information, the more knowledgeable hands, the calmer hands, they're less emotionally reactive because one, it's not their money, and for two, they know exactly what they're doing. They have a structured, disciplined plan of action on what they're going to do. Do they buy low or do they buy high? Do they sell high or do they sell low? I'm asking this question facetiously, obviously. They buy low and they sell high. Well, after a 50% drop, would you say that that is a lower price or a higher price? It's a lower price, about 50% lower. And so if you see massive trading activity, there's only one group that can do that. It's not some guys on Reddit, I assure you. There's only one group that can do that. That means that group believes in the 20-year treasury via TLT. Why? Because buying happens at low prices when no one else buys by institutional investors. We know that because they're institutional footprints. Now, what happens after institutions buy something up and they have a lion's share of the supply of that stock or that ETF or that treasury, what have you? What happens to price? Well, price tends to rise. That's why a few weeks ago on this very show, I was looking at TLT and I said, oh, look, looks like a great time to buy at $91.80. So let's move on. So we look at a big chart here, a monthly chart, which tells us this has been being purchased for a year. And we go, okay, that's a nice chart. So there's definitely something worth looking at. So what do we do with our time frame, everybody? We zoom in. And there's that volume right here. There's all that trading activity. So if you really wanted to separate price from volume, you'd have to do something like this. Look at that. And you still have a hard time doing it. All right. But you sort of did it. Now, let's zoom back into the way the weekly chart should look. Yeah, that's good. A couple years is what you want to see. All right, and here we are. So here's all of that trading activity and all of that volume. So far, price has gone from somewhere down here in 85 or whatever it is, doesn't matter, up here to 98. So we look at that, we go, okay, here's the volume, there's the trading activity, right? So here's our trading activity. Bada bing, right there. We know who those players are. Let me see here. I am going to put on. I am going to put on a little music today. Why? Why not? Gorgeous, gorgeous girls who love to fuck with the world. Gorgeous, gorgeous girls. Oh, this is like, oh, okay. You can now get almost anything you need for your let's go over to this here. What do we mean by almost? When you can't get a well-groomed lawn. I don't like. I don't want the music to be overpowering, but put a little speaker outside. But if I'm gonna sit here live and what do we got? Oh, we got a few people on. That's nice. All right, we're gonna come back. Okay. So anyway, let's take a look again. So here we are in a weekly. We can see the interest. What we're looking for now is, well, how much interest is there? where do we come up with a price target, right? I mean, that's what we ultimately want to do anytime we're looking at something. We want price targets. So we look at the weekly. I don't see any area here where you go, oh, there's a price target. Perhaps you could say where it broke out and it hasn't returned just yet. I mean, if you were really a long-term investor and you're like, hey, look, all I want to do is make the big swings up and I want to miss the big swings down, I suppose you'd say somewhere around 133 is a reasonable price target on this weekly chart. So let me erase that line. Let's zoom in a little more. Let's see. There we go. Now we've zoomed in a bit more. And what do we see? We see all this is now we can say, okay, here's the trading activity for 2024. And then you can begin to evaluate that. This back here, if you go watch my live right around where we hit 100, was when we were raising some cash in this particular security. And the reason for that was, what is this here, everybody? What is this? I don't care what you're looking at. Every chart is independent of each other. And look at that. And this is at the highest price. Let's draw the wire here. This occurred at the high price, which means even if it's just going to be a 5% correction, even if it's going to be a 2% correction, there's a correction coming. And what do you know? It was about a 6% correction, which is roughly what I said it was going to be. I said it was going to be 5%. It dipped an additional 6%. So what? No big deal. But anytime you see volume like this, and if you look around it, it's not like it's crazy high, but it's high. And we're in a very high volume situation right here, right? But again, every chart is independent of its previous chart. Let's remove those. We're going to zoom in yet again. The wrong way. As you can see, I ran to you, only blue or dark days. All right, here we go. There's that big volume at the top. So now you can really see how it stood out. On a 4-hour chart, way, honey, there is no right way. Just a little or a little bit every day with someone new. So as you can see, it's still substantial, right? And that is why price dropped. And where was price going to drop to? Well, price would traditionally drop to its previous resistance, which would have been right in here somewhere. And oh, what do you know? There it is. Now, you say, what do I do now? Where do we go now? Well, first off, we have to zoom in because that has completed, right? This substantial amount of trading activity corrected 6%, which is very traditional. Markets have to move. There have to be fluctuations, or else there is no market. That's what a lot of people fail to realize. The market's comprised of small fluctuations because it's a business, and that business has to run every day. And like every other business on the planet, this business has to be profitable every day. Okay. Let's zoom in. So this song, I like it a lot because it says there is no right way. And honestly, there is no right way. The way that is correct is the way that works for you. Now, I can show you mechanics and I can even tell you the standard emotional reaction of retail. So, for example, when you see a big gap like this, especially on something like a 20-year treasury that has just moved, like, I mean, how much volume, how much trading activity is occurring right now is unbelievable. So if you think gaps like this aren't going to fill, great, good luck to you. But this is another very easy way to say, okay, there's your price target. Why? Because there's a gap. There's a gap from here to here. Gaps fill, especially in something with this level of institutional trading. All right? They just do. That's what gaps do. They fill. Let's get rid of those. Now, if I say that gaps fill, well, where's the fill for this gap? What about this one? That's a good question. Here's a gap down. It fills. Here's a gap down. It fills. We have an open gap, don't we? Interesting, huh? So what do you think? Is it over? Zoom in. Gap filled, gap filled. You had some follow through, only it's gapping down. What do gap downs at high prices, what do they typically use for? Why would you take a price? So you own a lion's share of the supply of something, right? You own a lion's share of it. And you're at a high price. So you're at a price that's great for you to sell. Why would you gap a price down? Why would you skip? So if you own something $100, why would you skip through the ability to sell at 98 or at 99, 98, 97? Why would you forego those prices to sell your supply and drop straight to 96? Because you're not looking to sell, you're looking to buy. You want to scare out as many weak hands, less knowledgeable hands, retail hands as possible because you want to own it all. That's why you gap down at high prices. That's, by the way, that can also be a great way after a run down. It works at high prices and low prices, but you do have to watch low price gap downs because if they fill, usually that means prices are going lower. I don't want to get into that nuance right now, but right now I want you to focus on fear and greed. And the greed is I want to own it all, and I'm the institutional investors with all the information, the more knowledgeable hands. I'm the greed. The fear is retail, the less knowledgeable hands, because I can push them around with their own emotions for a couple of reasons. One, I control the supply, therefore I control the price. All right. So when you see something like this, what are the odds? Are the odds that the gap's going to fill and it's going to pull down? Or are they odds that it's going to fill and go up? It's going to fill and go down traditionally because they're looking to pick up more supply. They want to own more shares. They, institutional investors, and the more knowledgeable hands. All right, let's cruise down. We're going to keep breaking down TLT, which is the 20-year Treasury, via the ETF TLT. Now, what do we have down here once again? This is a great way to manage risk, by the way. Gaps are an amazing way to manage risk because right now you have a gap right here just below you. So when we talk about gaps, and when we look at gaps on this chart, are they all filling? Yes. Even the small ones are filling. Look, here's a gap. Here, let's draw where it fills, just so everybody is aware of where it's filling. Here it filled. Okay? Right there. Keep hitting the wrong button. Sorry about that. Gap. Filled. Gap. Filled. Gap. Filled. Do you see? There's nowhere on this chart because this is institutional money. This chart will flow. Gap. Filled. Do you see? And here we have a gap. What's going to happen there, everybody? If you look at the rest of this chart, what's going to happen? 100% of the gaps on this 15-minute chart have filled. What's going to happen? This game is a game of probabilities, but it's also a game of understanding how to control risk. Now, we can say long-term, it looks like price, the move is up, right? The move is up on this chart. We go back and we look at all that institutional trading, all the big money hands and all that trading activity, the volume associated, and we say long-term, this thing goes up. But I don't care about long-term. I care about short-term. And maybe some of you don't care about short-term. I'm just saying, if you do, what do you do? You zoom in and you have to know where your risks lie. Right now, your risk lies right here, 97.75. Right now, that's where your risk lies, right? This is your risk. So if you're the kind of person, and this is where my mentorship program and my one-on-ones come in. I help people to understand what risk is, what their risk is, right? I have people come to me all the time like they're going to follow some of the information that I put out. I want you to think about something. I had an interesting conversation with a platform that I setting an account on to trade futures. Do you teach people how to trade? Well, I do teach people how to do that, but it's not by following or mimicking any of my positions. Why? Because that would never work. You're not me, and I'm not you. But after 25 years, I'm pretty good at identifying when someone's actually scared and they say they're not, or when someone thinks they have a risk tolerance that they don't, or they don't understand that this move from 98.50 to 97.75 probably only matters to a select few people, right? Odds are, why would you, if you're a long-term investor and a long-term trader, all you really want to do is avoid big bear markets, like 20 plus or whatever, and you probably want to avoid 10% corrections. That's probably all you want to do. Do you see 10% from 98.50 to 97.75? Then if I posted this and I said, TLT, 20-year treasury, pull down to 97.75, we're looking at a 15-minute chart. So that's probably, 5 to 7 trading days, that price should occur. It could happen much, much faster, by the way, because we're finally heading into fall. Usually this would happen within 5 days. And right now we're on a 15-minute chart. We haven't even gone to a 5-minute chart. It could happen much quicker. But anyway, I digress. Does this even matter to you if you're that type of investor or trader? Do you even care that this is going on? And that answer is no. So if you're on there and you're this long-term investor or trader, because those terms are interchangeable, by the way, if you're not active, your strategy is hope, wishing, and belief in a system that says buy everything and you'll do okay in the middle, which is never true in a bear market, by the way. So I don't believe in that system at all. I think the only way to actually invest, whether it's for a 50-year time period, for 7 generations, for the next 3 weeks, is actively. That's my particular position on that matter. That's what I believe. But you have to know what information matters to you. So here we are. Now you see, so now we've identified the risk. The risk is 97.75. Now you say to yourself also, so that's one step. So now we know our risk. We're sitting at 98.50. We have 97.75 below us. So our risk is about 75% or 75 cents on TLT. Now let's just say you bought in at 92. You own at 92. And you planned to build a position to 110. So you're buying in on the dips. Is that a big enough dip for you? Is 75 cents a big enough dip? That's less than 1%. If you're buying over a $20 period, let's say you're going to a 10% position. You only want to own 10%. That means every $2 it jumps, you want to own 1%, right? Or every $2 it falls, you would own 1%. Depends on your strategy. If you're buying through 110, it depends on your strategy, because your dollar cost averaging basically in at 102, right? Start at 92. Let's call it 112, so it's an even 20. You're buying in 1% every $2. Your dollar cost average will be 102 if you buy in all the way up like that, right? So if that's the case, would less than 1% even matter to you? No. Now, if you're buying in at 92, you were scaling out at 100, it pulled back to 95, and now it's rallied back up to 98.50. Is a 75 basis point or less than 1% important to you? Probably. You're playing a game from 92 to 100. You're playing an 8% gain. I'm assuming you sold off half your position at 100, right? You bought back in at 95. So now you're back in a 10% position. At 98.50, you're going, all right. I'm assuming you're going to sell off probably half that for 97.75 to buy back in. You see, It's how you're playing this game is based on who you are. And I actually don't consider investing a game. It's very serious business. I don't like people that come on here and joke around and make cracks. A lot of times what they're doing is they're removing accountability from the things that they say, right? They're not accountable for what they said. They were just joking, right? It's just more double talk. So I take this very seriously. I don't consider it a game, but I guess what I'm really saying is, so how you're structuring your investment process, that's what determines if this matters. And it's important that you know that. It's important that you know that. Let's move in to a 5-minute chart. We're going to move all those drawings. All right, here we are at 5 minutes. Now that this tells you, since this is filling right now, this is above you. For me, that's always good enough. I'm not a greedy man. That's way close enough. And this is what's below you. For me, if I'm playing a short game, which is the only reason you would ever be on a 5-minute chart, is if you're someone who plays the short game, you're looking right here, and you're saying to yourself, if it's me, again, I'm not a greedy guy, I'm probably scaling in about right here. Knowing that price will ultimately return probably at least to here, and probably more than likely it will go to here. And so then I evaluate my risk from that standpoint, my cash flow from that standpoint. And you're in a heck of a lot tighter, right? Now you can break this down even into ticks. You can break it down into 1 minute. You can break this down as far as you want to, but you're still following the same process, right? And by the way, this is a small piece of the process, because you don't even know if you should be in this security yet, right? What investments are appropriate for you? Is this even appropriate for you? Does this have enough risk? Does this have enough movement? Is it too slow? Is it too fast? Do you want to be active in something that's down 50%? Like, there's a million pieces to the puzzle. And what I actually teach people is how to put their own puzzle together. The goal is not, I have to reiterate this over and over, because I get certain emails and certain questions, and I can tell what they're, kids, I just follow you. No. And that's not what I do. But I'll tell you this, even if that is what you were attempting to do, I don't work in any positions with low volume that I would ever own anyway. So just know that, right? So if you were trying to do that, just know that I'm never manipulating a position, but also know that information is just information. I see a lot of information out there now, and I look at it, and to me, it does happen to be useless. I don't need it. And there's a lot of that, because that's not what I do, right? And there's certain information that truly is useless that people pitch is something very valuable because it's fancy. It looks very fancy. Woo! Put on a show, make it fancy. Now, I can tell you this. Any proper system of investing is complex, but it is broken down into simplified rules based on that person. So I hope this helped you. I went live with this. I can't see the questions right now because I'm actually doing this, and I need to see this screen pretty large while I'm doing it. So I'm going to stop this share and jump over. I hope this helped you. I hope this showed you, this gave you even more guidance, because that's what this channel is all about. It's about teaching everybody, just teaching you what I've learned over 25 years. And, that's what it's about. All right, let me jump back over here. So what do we have? I don't think anybody like on Twitter, for example, can even leave questions. So I'm not gonna ask for them, Oh, hey, listen, Ally Bank, I wanted to put this up. I have recently started using Ally Bank. I actually have been using them for a few years, right? And the reason that I use Ally Bank is I want to have banking outside of like Bank of America, Chase, all the traditional banking. And so I use Ally Bank, and I have to tell you, when I call, they pick up right away. Their customer service is great. I've only had one bad experience, and that was because I had to dispute a transaction. The transaction was like 6 years old or something, and they or 6 months old, and they said we can't go back that far. Whereas a traditional bank, it was about vehicle registration. I paid someone to go get it for me, and they said they couldn't do it. Outside that experience, locking and unlocking your cards, anything you can kind of think of is it works. And I happen to really like Ally Bank. That's a referral code for me. It's just a way for me to get referrals for a bank that I do use and I do love. And I think like if you're using traditional banking, for example, I think not to have like internet banks is a huge mistake. All right, I just do. I think nowadays with all the data breaches and everything with like I don't think Bank of America is going to go under, but like I lost my debit card for Bank of America. Okay, not lost it. Like I had to get rid of it. That big data breach that just happened. Like I think it was with the IRS or something. It was like federal, but when that data breach happened, I had to get rid of my Bank of America card because someone on TikTok was trying to buy things. There was a bunch of people trying to buy things with my card. Thankfully, Bank of America blocked everything as they're supposed to, but I could not reorder a card online. I had to go into a branch. And when I went into the branch, you'll never guess how long the line was. Just I had to take in a social security card. Let me turn this down just a little bit. I had to go into the branch and listen, the wait was 2.5 hours. I still don't have a Bank of America card because I have to give my social security card, my birth certificate, and then they'll issue a new card. They're doing it like, look, it's a good thing what they're doing. They're trying to verify my identity. But with Ally Bank, thank God I had them. I simply Zelle from Bank of America to Ally Bank or Ally Bank to Bank of America, and then I still have a bank. So I still have, I'm still able to do everything I'm always able to do, and I can still run everything through my business account, which is at Bank of America, because I just simply Zelle right over to Ally. So listen, if you don't have an internet banking account, like and look, this is a huge institution. Scan the QR code and go over and sign up for Ally Bank. Look, the accounts are free. Bank of America charged me $16 a month. My bank account with Ally is free. Go over there and sign up, and I get a referral fee, which is one way I can kind of keep a channel like this making sense for me personally to sit on here and do this. And then I also, obviously it does other things for me. It reiterates what I know. By teaching, I'm always learning. So I enjoy that as well. But there's the QR code. If I'll leave that up there for about 30 seconds, and then I'll take it down. I see 5 or 6 people right now watching. I'd appreciate it. Go get your free account. It's a good thing. I'll leave it up for about 30 seconds. Hey, I hope everybody liked the breakdown of the 20-year Treasury of TLT. I hope everybody enjoyed that, and I hope it was informative because that is the point, right? My point is to educate, and I feel that I'm always doing that, but I've noticed lately some people have been asking me about just following what I'm doing and whatever, and that look, that's for hacks. I don't do that, right? I wouldn't do that to somebody because that's just leading you down a path to failure. It really is. Just so you know, I want you to understand that that's just leading you down a path to failure. If you're trying to follow somebody's positions that they're posting on Twitter, and I don't care what it is, I don't care who they are. If they're talking about market making activity with Greeks, if they're talking about options, if they're talking about stocks, if they're talking about futures, if you're just trying to mimic what that person does, you're doomed to failure because you and that person may have exactly nothing in common. From a personality standpoint, from a financial standpoint, from every standpoint, which means you'll fail. That's not what it's about. You have to learn this stuff so that you build the confidence behind you. When I say the more knowledgeable hands, you can become them. Please remember that. You can become them. In fact, let me throw something up. I think that's enough with the Ally Bank for now. I just thought I would show that so that some of you might actually join in and do it. For me, it saved me several times. So I have to back it up. But speaking of doing, oh, look at that design now. That's completely different. That's okay. I like that. That's nice. So anyway, my VIP mentorship program starts next Wednesday. I do 2 educational classes a week. I'll do one Wednesday, one Friday. They'll either be midday and late afternoon, or they'll be late afternoon and early evening, depending on your time zone. And then I do a Q&A, and of course, you get the live recordings. That's an 8-week course. You'll learn how to identify trend changes. You'll learn we'll go over the 3 pillars of investing: risk management, cash management, investment management. You'll learn a lot about how to identify trading activity, aka volume, what price should really mean to you. Let's see, and how to set up a proper investment plan so that you go, hey, maybe this investment does make sense for me. Maybe it doesn't. Here's where my risk management lies. I only want to spend an hour a week or 2 hours a month or whatever it is. I'm looking for the big moves. This isn't a big move. Whatever it is, you'll learn that. And then I have the one-on-one coaching with me, which I strongly encourage because it helps me to know you. And a lot of times, because I've been doing this for 25 years, I see your actions and I can tell the way you're reacting to certain stimuli. And that lets me know where you're at. And I can help you make adjustments for yourself. Like I go, you're saying that you don't mind a 10% drop. But do you remember when we were watching the NASDAQ and it dropped 5% and you started to panic? You said, hey, we need to sell. We need to get out of this. I said, wait, where do we buy back in? I don't know. I got to get. And so I say, well, you might not be a 10% risk guy, right? So I just guide you along the path. I educate you on the process and I give you guidance along the path. And by the time we're done with our coaching sessions, and they come in packages of 40, by the time we're done with those coaching sessions, you'll have an investment plan built out for yourself. You will have some confidence behind you, and you'll be able to look at information and know whether or not this is for you or it's not for you, or what kind of trend change this is. And maybe, just maybe, and instead of riding those bull markets up and making a lot of money and then giving a bunch of it back, you'll get to keep it, right? And that is probably, I would say, 95% of my students come to me. And the fact of the matter is, they're like, I know how to make money in bull markets. It's just once the trend changes, I give most, if not all of it back. And a lot of times I lose some of what I put in. So that's most of the people that I deal with, because a lot of this trend following stuff is Fibonacci and moving averages and stochastics and MACD and RSI. These are all lagging indicators. They're not actually going to identify a trend shift. They're not. They're lagging indicators. So just be aware of that fact. And if you don't know how to identify trend shifts, trend changes, and you don't have a rule book set out for yourself, designed for you, you're just doomed to failure over and over. All right, I think that's enough preaching. Let's go ahead. Hey, I'm going to screen share again. I think we'll just run through the NASDAQ. Let me see. I don't think anybody's asked me any questions because I didn't see anything pop up. No. And I know a lot of you guys are on Twitter, so I don't think that that I'm going to get a lot of questions here, but I'm doing it anyway. So if you do have some questions, make sure that you comment those questions, and I'll answer them to the best of my ability. All right, let's hide that, close that out. And here I am. I'm going to go ahead and share my screen with you. Let's go ahead and jump into the NASDAQ. Let us see what's going on. This is for some of you, this might not be your jam, this might not be your music. And sometimes it's not my jam either, right? This is just not what I want to listen to. But at the moment, into it, dude. Into it. You know what? I'm gonna jump over. Hey, I'm trying to look at this screen small. I'm not gonna do that. Here we go. Let's look at NASDAQ. Let's look at it again. We always start with the month, right? I'm almost me again. She's almost you. With nowhere to start. Sweet music playing in the dark. Now, do we see anything here that pokes us in the eye? Whoop. Let's take this over. Do we see anything here that pokes us in the eye? Yeah, but it's behind us. It's back here, right? There's nothing right now that's poking us in the eye. This pokes you in the eye. Does any of this? Hold on, look. So people try to tell you there's a big crisis going on, right? Oh, God, there's huge. Where's the crisis at? That's a crisis back there. This is 2008, 2009. See that? That's 2008. That's a crisis, right? This is 2020. Look at that. Look at now. All right. So we can all agree it's business as usual. Yes? Like me again. She laughs like you. Wouldn't know where to start with music playing in the dark. Okay, here we are. This is 2021. Here's the drop. What do we see? Where's those institutional footprints? How could we have possibly known that we should be getting back into the market? Look at this. Look at that. And this is pretty much the low. Close enough. What is it? 280, and I think the low is like 255. Yeah. So if you start scaling in here and it bounces up and you're scaling up, return, you would have known how to identify that anyway, right? That's not a difficult thing to identify. Like right now. Oh, what's that? Oh, that means all this at the low, that's the highest volume. You see there? Yeah, that means it was buying. That means there was inevitable bounce. So when everyone was talking about circuit breakers and market crashes, they didn't know what they were talking about, did they? So everything is relative on a chart, all right? You have to remember that. This part, look at this. Look at that volume. Do we have anything like that right now? Do we have anything like this? No, but it's all relative because as you zoom in, this bar right here is going to become more substantial. I'll show you. You'll see. It becomes a lot more substantial. Well, Derek, I don't see how you identified the high. That's because of how we're looking at this chart. Because we're looking at it backwards. Look. Let's go back. All right, here we are. This is 2020. This is February of 21, right here. Now let's move forward. Now, what do we see here? All of a sudden, you have volume bars. See these volume bars? Look here. I want to show you something. Because when you look at it backwards, you go, you couldn't have seen that. See this? See this? It's volume, trading activity that is nearly as high as 2020, which took place at a dip, nearly as high as what took place in March of 21 during a dip, only we're not on a dip. We're at a high price. You see, trading activity at a high price is what? Maybe it's just the selling of this. Maybe it's just the selling of this. But it is selling. How do I know that? Because that was taking place on a dip. Oh, that's not a big dip. No, that is from 337 to 297. Okay, that's 40 points. That's 12%. After a 12% drop, you saw massive trading volume. Yeah, it's a dip. This is not a dip, folks. This is a high price. Look at that. That's, in fact, the highest price. Okay? It's the highest price. That's selling. What's going to follow that? Bare minimum, what's going to follow that is a correction. Bare minimum. And I believe this is in December because I remember, look, I remember looking at this. Volume went up 300, 500% at the beginning of December in 2021. And you're telling me during the holiday season, volume, aka trading activity, that combats the fall of 2020 and a 12% drop, which took place in February that year, means nothing? Come on, wake up. You can see this stuff. You can see it. This isn't mysticism, guys. This isn't mysticism. This is real simple. It's selling right there. Now, as you move it forward, look at that. Okay, so you didn't see that happen. You missed this. Somehow you missed a 500% increase in volume at the highs. Well, price dropped, and now we have a big, huge piece of trading activity right here. Look, right there. Huge. And it's after this went from like 408 down to what here? I remember this. 330, dropped 70 points. You're at 18% drop, massive volume. Do you think the price is going to rally a little bit? Probably. But if institutions started selling here in a meaningful manner, mind you, that is a 300 to 500% trading activity increase, volume increase at highs. That is actual selling, real selling, not selling to scare you out for 10% and pull back. Real selling. Odds are it's going to rally and then do what? It's going to pull off and go lower. Oh, well, you're saying that because you have already seen it happen. Well, no, I'm showing you how I'm saying that. And by the way, you can look up my posts from back then, and they'll tell you exactly what I'm telling you now. Get out of the way. Look at that. There's your rally. There it is. And there's your rally on far weaker volume. Here the fall goes. Now we have huge volume, which means there's still a ton of supply down here at 300, but there's also a huge volume bar, a ton of trading activity at 300, but there's obviously still a ton of supply as well, meaning stock. How do I know that? Because it combats the previous high trading activity volume bar, which combats the 2020 lows. So as we move forward, we know we have to go lower than 300. Here we go. Now what we're going to look for is volume to dry up, because what we need is a return to this low right here at 268, and we need there to be a lack of volume. Why? Because that means most of the shares are picked up. That means they own most of the shares of the stocks that they want to own in that particular index. And in this index, it's the NASDAQ. Price runs up, pulls down, and what happened to volume? It's funny every single time. Look at that. That's volume now. Pretty much back down to the average. Remember where I drew that average? Look at it now. That's where your volume fell to, and that is the bottom. And that's how you identify trend reversals. That's one piece of the puzzle. And now you know you're going to break through the highs because this was real selling, and this was real buying. So you know you're going to new highs. That was almost never in question. In fact, go back through my posts and find it for yourself. Now, let's go up to today, and let's evaluate today. Now, here's something interesting. At the high, there's not an increase in volume. There's not an increase in volume. See that? There's not an increase in volume. Price pulls down, and there's a massive increase in volume. And now we're running up. Let's go take a look at what that means. So we're still on a weekly chart, everybody. That's still a weekly chart. Let's move into a daily. There's that big volume bar. There's that massive trading activity. Now, what do we see? We see gaps. What do we use gaps for? Risk management. What do we see now? Well, we see a couple gaps below us now, and we see gaps above us. So what are we looking for? Well, let's talk through it, everybody. I want to show where these gaps are. So gaps that are not filled. Here's one. All right. Here's one. And as we zoom in, you'll find this is one here as well. So I'm going to highlight it anyway. And this is one. Now, you're investing, you're a smart guy. You realize that this is probably where price returns because this is an index after all. And indexes fill, 99.9% of their gaps? Since the Great Depression, kind of have a big track record. A pretty good track record, huh? So let's say, what do we have below us? Well, here we have 465-ish. Call 465. I don't even know. This might have technically filled. I'm not zoomed in enough. Doesn't matter. Let's call 455. All right. And then above us, we have this. Now, if we're looking at this and we say, well, which way is the market going to go now? First off, we just set some levels. So now we understand what levels we're dealing with. We're dealing with 493, 465, and 455. So we know what levels we're dealing with. Great. We understand. Now what we want to do is we want to zoom in on this entire picture, right? Electric feel now. That's right, feel, emotions. That is, in fact, what guides a market. Emotions. So here we are. We're zoomed in. We want to zoom in on that picture. Why? What we want to know is 494, 265, or 255. Where should we really be looking? In what order should we expect that to take place? So let's move into a 1 hour chart. All right, what order do we expect that to take place? So gap down, big volume, price follow through. This obviously takes a long time to fill. Are we on a path to filling that now, or are we on a path to going down? Let me ask you this. Does it matter? Does it matter? So we just walked through the NASDAQ, and what it looks like to us is that NASDAQ is in an upward trend over the long term, right? It's in an upward trend over the long term. So why couldn't you set a buy order there, set a buy order there, and we know you'll get a small reversal bounce here at least, right? And set a sell order here. Why can't you do that? Who says you can't do that? Why can't you do that? And then just walk away. If it hits here and you buy it, it rallies here, and then it sells, and you get yourself a small reversal, which you should. All you simply, or let's just say, okay, then you get a small reversal. You can readjust and figure out where your next buy order is, if this is even appropriate for you to be doing. But what happens if you hit this here? So in your short-term trading account, you hit this here, and then it rallies up here, and it sells, that same position sells, and then it rallies higher, and you've missed out. What did you really miss out on? Well, you know it's going to return to the previous high right there. So you'll set a buy order there. And when it goes to the new high and it reverses, you'll buy here. So what'd you really miss? You missed from 503 to 495. You missed nothing. And how much risk did you reduce? A ton. See, that's just risk management. And within all that risk management, you have to determine how much should you be buying in? How much should you be selling out? That's cash management. And then, most importantly, should you even be in this index? That's investment management. Right? So I hope what I just showed you is how you effectively and accurately create a position. That's one position of an investment portfolio you should be designing for yourself, because no one else can do that for you. You can have guidance, which I offer in my one-on-one coaching and in my mentorship program. Let me see, where is that? Let me put that up for you. My mentorship program starts next week on Wednesday. I do that twice a week, Wednesday and Friday. It's either early afternoon, and it's like directly after market close will be one session, and another session will start about 3 hours later. One on Wednesday, one on Friday, and then I do a live Q&A once a week, and you get the recordings of those sessions as well. That's an 8-week course. We learn how to establish a proper investment plan, proper risk management, proper cash management, proper investment management. Over those 8 weeks, we learn how to identify trend changes. We learn how to identify target prices, right? We learn what investments are appropriate for what kinds of people. And we do this live every week. Each session's an hour. We jump on. I only allow 5 students in the mentorship. If you're watching this on Twitter, to purchase the mentorship, it's right there. If you're interested in the mentorship and you're not on Twitter and you're on one of the other channels, pull up dmiller@prometheaninvesting.com. Shoot me an email. I'll fill you in with the details. If you're interested in the one-on-one coaching, you can either shoot me an email, or for either, you can also go to prometheaninvesting.com and send me a contact form, and I'll get back to you. But what we go over is what I was just showing you in far greater detail, and how to identify trend changes in all sorts of positions: commodities, crypto, stocks, bonds. I mean, you name it. Okay. We go through everything because the truth is, what I'm showing you right now transcends the investment. You can do that with any investment. Doesn't matter what you invest in, and it will work over and over and over. Why? Because we are identifying. I hope everybody had a chance to see that. The reason that it will work over and over and over is because we are simply identifying institutional, more knowledgeable hands. We're identifying their footprints through the one thing they can't hide. That one thing is trading activity. How does trading activity show up? It shows up in the form of volume. Well, what in fact makes up volume? So this is something I go over with people too. What in fact makes up volume? Well, what makes up volume are shares traded. Well, what makes up shares traded? Money. Every share costs money. So what you're in fact looking at is cash flow in and out of a position. How much cash is moving around in that position? And then is the cash, if there's big cash moving around, is that big cash buying or selling? That's what you're learning. And so, listen, what is anything worth in this world? What's anything worth in this world? What someone is willing to pay for it. What controls what someone's willing to pay for it? Well, if you think of this as an auction, right? You get 105, it's bidding up, right? 100, 102.50, 105, 107.50. They're bidding it up. How are they doing that? They're adding money to the pot. So if I'm the guy in control of the majority of the money, and I'm a guy in control of most of that stock, or I have a large interest in that stock, if I want to move price, what do? I pull some supply out of the market. If demand stays constant, price goes up. If I want price to come down, I simply dump my supply onto the market in a manner that's abnormal. And people will view that as selling, and therefore they'll get scared and they'll sell out, and then I'll buy back cheaper. And that's how a market moves. So you can say it's based on mechanics, right? You can. You can say, look, there's a support here, there's a resistance here. Wait, support here, resistance here. Here's the moving average. Here's my Fibonacci, blah, blah, blah. And then you go, how come it gets blown out? Because what happens to everybody that uses these indicators as a forecasting mechanism? And I have news for you if you're using these indicators. I'm not telling you not to. What I am telling you is these are lagging indicators. They look backwards. That's why they never work in forecasting. That's why you make tons of money during the trend, and then you give most of it back, if not all of it, and then some. Or maybe you even keep, like let's say you keep 50% of your gains. Because those things you're using, they'll never identify a trend change. Someone who uses Fibonacci will just keep broadening the Fibonacci bars further out, further out, further out, right? He's using time frames, but it doesn't identify trend change because it's looking at the wrong thing. You have to look at cash flow. Someone will say, oh, Powell's going to speak, or this is going to happen, or that's going to happen. Well, do you know when our last correction in the NASDAQ ended in 2022? Do you know the day? I do, because I said buy the farm. But do you? It was when they announced the Ukrainian war, and they said that the U.S. might go to World War III. That was the bottom. Oh, well, wars are good for the economy because they're good for defense spending. Oh, is that right? Tell 2001 to 2003 that. Anytime you point out that a war has helped, I can point out that a war didn't. Why? News is ancillary to the movements of this market. I'm not telling you things don't catch up. What I am telling you is cash flow controls any market. We proved that in 2021 with real estate, didn't we? Real estate has skyrocketed. Everybody's under this impression that we have a supply issue, which we do not. Now, corporate America is certainly holding on to quite a bit of their supply because they have huge balance sheets and they can afford to. So they're just simply not going to sell cheaper. And what media wants you to do is they want you to be mad at baby boomers who live on golf courses and not corporate America and not the system that is created to allow these companies to buy up real estate and hold it forever. And they want you to be mad at a generation above you. You can't be that. I have great friends that are baby boomers. Let me tell you something. I had one of my good friends, her dad, he's obviously retired and he's in his 70s. And do you know that for every day of the last 10 years of his employment, he counted down the days day by day because he hated the job that much? I'd like to know who today, in today's world, hates their job that much. Because if you hate it that much and you saved up this money for this house, I highly doubt you're going to scale down and move into an apartment. You lived through misery 5 days a week for a decade, and now, well, it's for the greater good. Well, you know what else could be for the greater good is that corporate America can't buy up all of our housing at interest rates that are 99% below what the average person can, and then sit on them. And if you don't think that that's true, you can go on to any rental site you want. You'll find plenty of homes on there that have been sitting there rent unchanged for a year and a half. That's changing now. It looks like it's starting to bite them in the butt enough where they will sell. Because always remember, I'm not against corporate America either. But remember that they are going to, where there is demand, they are going to go. Where there's profit, they're going to go. That's their job. That's not an evil empire. That's their job. In fact, it's the law. Their law is to put stockholders first, profits first. That's the law. They can get in trouble if they don't do that. And that has somehow been lost, I guess, it recently, as though that's not the case, but it is. However, they own something and they're trying to rent things at things that aren't affordable. No one can pay the prices they're asking. Very, very few. Very, very few. Which means the masses rent. What's that mean to rental prices? They can't just sit there forever. What will have to happen to rent? It has to come down. So what has to happen to home prices? They have to come down. They have to. Cash flow controls a market. There's no cash going into real estate right now. Why? It's too unaffordable. It's built for what? Maybe the top 5% of the country? I mean, I don't know the number, but I'm just saying, if I were guessing, I'd say the top 5% can afford real estate. Everyone else right now is getting crushed. Unless they bought a home 15 or 20 years ago, right? Which, great, good. But just remember something. If you're one of those people jumping up and down about the value of your home, realize that home prices are, around the LA area, which is where I live outside, you're looking at for a decent house, $5,000 a month. Otherwise, you're living in a townhouse or an apartment. And even $5,000 a month, this is not a big home, right? This is 1,200 square foot, 1,400 square foot. You're asking $5,000 a month. What is $5,000 a month? $5,000 a month is $60,000 a year, right? You throw in taxes, and California taxes at 50%. You're talking about a $120,000 a year job just to pay your rent. I know there's this fantasy online and through social media that we're all driving Lamborghinis and skydiving. We're doing all these things. I love how we're doing all these things simultaneously. We're driving a Lamborghini because we're a hardcore hustler. We're hustling, son. We're getting money. But then at the same time, we're living our best life. I'm in the woods. I love the woods. I'm in nature. I'm going back to my roots, right? These two things, by the way, do not go together. And neither of those two things are true. Most of us are trying to live a nice, happy, healthy life. A lot of us work pretty hard, and a lot of us try to relax pretty hard, and some of us party pretty hard if you're in your 20s. I'll bet that's you. Was me, that's for sure. But we're all living real lives, not any of that social media crap. And social media crap doesn't actually rent houses. So maybe some of corporate America was even fooled by what they see online. I have no idea. But I can tell you now, when I go onto the rentals around me, $500 price drop per month. That's monstrous. $1,000 a month price drop. I saw one last night, $785 price drop. And in my personal opinion, that's the beginning. And why are we talking about real estate right now? Because I'm trying to talk about cash flow. And I don't know a better way to talk about cash flow than the fact that that particular market was dominated by cash flow. The Fed, the Federal Reserve is not the enemy, right? They follow the orders of Congress, and then they have to deal with the consequences of the orders that they're given. So let's be honest about the Fed Reserve. Congress passed the COVID Relief Act, which was $1.5 trillion. All that currency got pushed into the market. That's cash flow. That drove real estate through the roof because cash flow, but now that cash flow is gone. All right, real quickly, everybody, I want to talk about Ally Bank. Why? That's my referral code, so I'm going to use it. But the truth is, they sent me this like referral code this morning, and I had an incident really recently, and I realized lately that I need to have several banks anyway. I personally have realized that. So I have some online banks. I have some banking that I can do on the crypto side, and then I have my traditional banks, which that's Bank of America, Chase, and all those guys. What happened to me was recently, I think it was the tax thing. It's like all of us lost our identity a couple months ago. Like our identity was given to everybody. So someone went on to TikTok and a couple other places with my particular Bank of America card, and they used it, and they're buying all this crap. And so while buying all of this crap, it got blocked, thank goodness, on Bank of America because somehow they got my identity and they're online buying all this crap. So thank goodness that I had my Ally Bank, because when someone takes your identity and you have to cancel your debit card, you have to go into the bank. You have to take a birth certificate, a social security card, and a driver's license. And then they'll reissue you a card, which honestly is to help you. Like they're trying to protect you, right? By verifying your identity because your identity was stolen. The wait in there in the Bank of America was 2.5 hours. So I've been using my Ally Bank. So it's simple. I can just Zelle from my Bank of America to my Ally. I still have, everything can still flow into the Bank of America account. I just don't have a debit card. But because I can just Zelle over to Ally, it's no problem, right? So I've been using my Ally Bank. So I got a referral code. It does something for me to stay live. And I can say, honestly, I can talk about this stuff all day and stay live all day. But for me to stay live, this is a way for me to support myself, because I don't even know exactly how much money I get for referring this. But I can tell you this: I have no problem saying to go and use Ally Bank because I use them, and I've been using them now for a year. I've never had a problem except one. I had a registration. I had to pay someone to go get my registration because I was up on a mountain and it was like 2 hours down the hill and it was in the snow. I had to pay someone to go get the registration, and I paid them to do so. And they never did it. They never gave me my plates. I moved. They never mailed me my plates. So I disputed the transaction with Ally. They were unable to give me that money back because they said, oh, that was over 6 months ago. We don't refund anybody if it's been over 6 months. So I did not get a refund from Ally Bank. And it was substantial. I mean, it was $708 to be precise. So I wasn't happy about that. But outside of that, I've never had a bad experience. They basically said you have 60 days to dispute anything, and they give you the money right back like any other bank. But just be aware that is a problem I had. But outside of that, I've had no other problems. So there's a referral code for Ally Bank. Please use it while I'm live like this. It gives me I don't even know exactly how much I get, but it'll help me stay live a little bit longer. So I haven't had any real questions yet about anything. So we went through the treasuries and how that works and why that's important. And we went through the NASDAQ, how that works and why that's important. And we've talked about two different areas. For those of you that weren't with us, I have a mentorship course starting. Where is it? Here it is. I have a mentorship course starting next week. It'll be Wednesday and Friday. One of the classes will start directly after the market close. The other will start a few hours later. I'll make those at different times on Monday and Wednesday, so everybody always has a chance to attend. You'll get the recording for that as well. If you are on my Twitter account, you can literally just purchase the mentorship course there. I only allow 5 people inside the mentorship course. So if you would like to be one of them, I would get signed up. I have 2 spaces left right now. You can also go to my website, prometheaninvesting.com, or just email me, dmiller@prometheaninvesting.com. We can set up a time and we can even just have a conversation about what it entails. I can get you some more information if you'd like it. I also do one-on-one coaching, which for me is preferential because I then have the ability to get to know you and know you pretty well. And I help you build out your investment plan, which focuses on the 3 pillars of investing, right? Risk management, cash management, and investment management. So I think that's a great idea. Again, you can email me, go to the website. Let me go ahead and hide that. Let's see. What time do we have here? We are looking at 9:30. So we're about lunch break. I'll tell you what, I'm going to end the stream for now. And then I am going to, I have a couple of things to do. I'll be back after market close and we'll see if we have any interest there. I realize it's Friday and after market close, so there may not be. I hope you enjoyed this live stream. If you did, please, I post a lot on my Twitter account. My Twitter account's kind of random. I think I need to change it because some people get confused. They think it's a bot. It really is Derek DEREKMI 752-636-05. I know that seems like a bot account or whatever, or I've been told that, but it really is Derek DEREKMI 752-636-05. That's my Twitter account. Go follow me over there. My LinkedIn account is Honest Trader. So if you're looking on LinkedIn, it's Honest Trader, and that's me, Derek Miller. And if you would like to reach me, like Instagram, Facebook, all the other social media channels, reach out to dmiller@prometheaninvesting.com, and I'll be happy to get back to you with any information that you need. All right, everybody, I appreciate you tuning in. I may come back in an hour or so. I don't want to make any promises. I'm not sure. I do have some actual work that I need to do, although I love these live streams. And I know they're beneficial to everybody and they educate. So that's the goal. All right, everybody, thanks so much for tuning in. Remember, if you're not good up here, you're not good anywhere. Don't sit behind these computers all day. Get outside, see the sun, take a walk, smile for an hour like an idiot. Fake it until you make it. You've never failed yet. How do I know that? You're still here. So you're batting 1,000. All right? Remember, every day above ground is a good day. I'll see you.